This is the current federal tax developments for the week of October the 6th, 2025. Current federal tax developments are brought to you by your state society of CPAs. I'm Ed Zollers, and I'm broadcasting this week from here in Phoenix, Arizona. Looking here in the first week of October as we get our way slightly out of the major summer stuff and get just into just below 100-degree highs for the day summer stuff. We've got some developments. First, we have the IRS reducing by $1 your PTIN user fee for the coming year. We have a withdrawal of corporate reorganization proposed regulations by the IRS. As you probably have heard, there has been a government shutdown. We will discuss the initial IRS plan for the shutdown. Now, this plan only runs through Tuesday. So basically we've got a 5-day start. So we don't really know what happens after Tuesday, but we can talk about what happens up to that point. The IRS issues some new OB3 guidance with guidance on rural qualified opportunity zones. So some definitions there with the law changes passed this summer. The IRS has issued revised guidance, interim guidance on the corporate alternative minimum tax. We have an extension of tax relief related to terroristic actions in Israel. This is a third extension, basically, that we've had, so it's a continuation of prior ones. We have final regulations issued on interest capitalization for improvements under 263 Cap A. We have the 8th Circuit Court of Appeals reversed the tax court in the 3M case on blocked income, and this one is one based on Loper-Bright. So we have one of the first true Loper-Bright decisions, I should say, where things really happen. We've had a lot of arguments that Loper-Bright applied, but this is a case where the Circuit Court of Appeals found that Loper-Bright did apply and, at least in theory, modified the decision, because when the tax court issued its decision, Loper-Bright had not yet come out. And following that, the Supreme Court issued Loper-Bright. Now the 8th Circuit has this case to decide, and they have decided based on that. We have a U.S. District Court for the District of Columbia that found the 501c4 standards for political activities for C4 groups unconstitutionally vague. But interesting enough, they discovered, but the IRS has been blocked by Congress from fixing them. So put the court in an interesting position. And finally, we have 2 separate tax court opinions issued effectively in the same case. This is the case of Green, which is the family that controls the Hobby Lobby Corporation. And they've had a lot of charitable contribution cases. It's yet another one. And so we'll talk about why we have 2 decisions, why the published decision, right? We have essentially a reported tax court decision or reviewed decision, and we have a standard memo decision. And we'll talk about why the review decision is interesting, because it really split the court in terms of how they decided it. So we had a split decision on whether or not, the court decided they couldn't decide at this point, and they turned down essentially a request for summary judgment on various issues, saying that, they know that they weren't going to do that right now. And we get an interesting discussion about whether or not the court should have decided something else first. So we'll get to that point. But let's go ahead and let's talk about our reduced PTIN fee. You've got a whole $1 here to work with. So the IRS is going to reduce the PTIN fees from $11, which were this year, to $10. This is Treasury Decision 10035, and that is going to essentially be, those are proposed regs. And then we have interim final regs in Reg Project REG-108673-25, which are identical interim final regs that set this rate. Both of these were published in the Federal Register on September 30th. What's happened is the Treasury and the IRS have issued those interim final and proposed regulations that reduce the IRS portion of the PTIN fee from $11 to $10. Now, don't forget, on top of that, you still have the third-party contractor fee for administering things. That's $8.75. So this change followed many years of litigation in the Steele and the Montrose case over the fee's legality and its calculation. Now, the legal authority to require a PTIN comes from Internal Revenue Code Section 6109A4, but the authority to charge a fee comes from the separate independent Office's Appropriations Act of 1952, the IOAA. Now, the precedent here was, in Montrose, the D.C. Circuit affirmed the IRS authority to charge a fee, but the district court in Steele ruled the fee cannot include costs for activities that provide an independent public benefit, only those that give a benefit to the PTIN holder. So those disallowed costs for general compliance, all suitability activities, and unrelated support activities were all disallowed. They couldn't be part of what factored into the costs the IRS would seek to recover via this fee. So on a new IRS cost model, they recalculate that fee based on the Steele opinion, including only direct and indirect costs for allowable activities like investigating ghost preparers and PTIN misuse. The IRS projected total allowable costs of $28.8 million over 3 years, divided by the projected 2.8 million applicants, resulted in a cost of $10.18 per PTIN, which was rounded down to $10. So that's how we get this year's number based on the projected costs. Now, the interesting thing is that this is something the service is doing, and they're changing their terminology slightly, right? The IRS issued both an interim final rule and a cross-referencing notice of proposed rulemaking. Now, the term interim final rule is one you may remember when we got back to PPP loans and confused a few people. Essentially, that's another term for what traditionally the service had referred to as proposed regulation projects. So it's essentially the same thing, but it's now using to be consistent through Treasury, because remember, the PPP loans were part of Treasury. And outside the IRS, the term interim final rule was a more normal rule. We're beginning to see more and more talks about interim final rules as opposed to temporary. There's still temporary regulations, the way they work, but effectively the same. Now, the interim final rule, why we have both, and they're identical, is because the interim final rule can be effective immediately upon publication. Now, the IRS have to justify why they would do so, but they invoke the good cause exception to bypass normal notice and comment period, arguing that it'd be contrary to the public interest to charge a higher outdated fee during the upcoming renewal season. So they want to get the new fee in place now. In theory, we have comments arising on the regulations. The text is identical. We have to, the IRS needs to formally solicit public comments for 30 days before they could issue a permanent final rule. And they just didn't want to delay that because they're going to be registering for our PTINs here shortly. So the practical takeaway for practitioners is that the $10 fee is effective now for the 26 filing season renewal cycle, but we still could have comments, and at least theoretically, they could change the final rule. I suspect they won't, because really the only change was to go from 11 to 10, and I don't see a lot of, prepare organizations saying, hey, you should charge more for this. I don't see that happening, but it's at least the way the project works. Next up, more IRS work in the regulations, again published on September 30th in the Federal Register. This is reversing course on proposed corporate reorganization guidance. The IRS was withdrawing proposed regulations, reinstating prior IRS ruling procedures, and the citations here is the RIN 1545-BR32 and 1545-BR00, which both announced the withdrawal of the proposed regs, as well as the issuance of new revenue procedure 2025-30. And again, all of this came out on September 30. And revenue procedure 2025-30 is basically saying, yeah, forget all that stuff we were doing. We're going back to the old methods. So what happened here? What was going on? Well, in January of 25, towards the end of the Biden administration, the Treasury issued some proposed regulations to deal with corporate reorganization guidance. And the two reg projects were Reg 112261-24 and Reg 116085-23. The first one dealt with substantive rules for corporate separations and reorganizations under Section 355 and 368, divisive reorgs. And finally, the second one dealt with multi-year reporting requirements on Form 7216 for corporate separations. And the reason for the withdrawal was the IRS received several critical comments from the public. Now, the proposed rules were meant to get away from issuing all this guidance, basically via private letter rulings. That's traditionally, and if you read private letter rulings, you'll find 355 rulings all throughout the PLRs over the years. They've been all over the place. They were trying to move away from that. And so giving what was going to be more comprehensive guidance, but it'll be comprehensive, but it'll straitjacket you a bit as well. So yeah, that was not a popular move among commenters, as we may see. Now, because they had kind of issued Revenue Procedure 2024-24, which essentially, put in new procedures while they were waiting for these regs to finalize, they've now issued RevProc 2025-30, which supersedes that rule, and it effectively reverses the changes that were made earlier this year. I realize it's a 2024 revenue procedure, but it was effective to start the year, and basically takes us back to where we were a year ago, right? Restores the prior ruling landscape for divisive organizations. So what got reinstated was guidance from RevProc 2018-53 that governs PLR requests on the assumptions and satisfaction of distributing debt in one of these reorgs, and guidance from Revenue Proc 2017-52, which are representations you need to make on control solvency in the applications of Section 357 and 361 to your 355 project if you are claiming you are going for the private letter ruling. You want to get one that's in your favor. So they revoked Notice 2024-38, and that notice dealt with IRS concerns on technical issues like plan of reorganization, debt modification. So essentially, the IRS is backing away from those positions, in that area. So that's really the major change. Now, some of the changes to satisfaction of distributing debt, ruling requests are going to revert to the old 2018-53 framework. Require a representation on historic debt, substantial obligor status, substantive, I should say, and limitations on debt replacement. We're also going to go back. So if you're involved in these, you're going back to what you've done before. For retention of controlled stock, it's going to go back to simpler representation in 2017, Revenue Proc 2017-52, that assets exceed liability. There had been more stringent solvency requirement rules in 2024-24. And practitioners must essentially now, again, rely on foundational guidance in this area. Things like Revenue Ruling 75-321 is where you're going to be in there. And for plan of reorganization, the definition reverts to the flexible principles-based standards of Regulation 1.368-2G, which the courts have described as having, quote-unquote, substantial elasticity. The proposed regs had a much more structured framework that would have been involved. That's gone from now we're back to the old methods. Now, why did they reverse? Most likely, the IRS decided the complex, fact-intensive nature of corporate reorganizations is better handled through the PLR process rather than a one-size-fits-all regulatory regime. It's basically stepping back and saying, well, this is an area where, PLRs handle this better. And that could be good news or bad news for you. The advantage of the other method was that, assuming you followed the reg, you knew your answer. The bad news was, though, that you lost a lot of flexibility. Now, the bad news for the current structure is obviously you got to pay for the PLR and pay for the drafting. It is messy to do these, right? So the IRS can now continue ruling on transactions involving issues not strictly defined as distributing debt, contingent liabilities on a case-by-case basis. So essentially, we're going back to the old law. You got to go. What you need to know a year ago in this area is essentially what you now need to go back to. We're not going to go to the new regime. That pretty much was done. We see this a lot of times with changes in administrations. The outgoing administration will try to wrap up a project and hope it sticks. And the incoming administration will then go through, review it, and some of those projects get reversed. And this is clearly one of them that did. Hey, government shutdown. The IRS published on September 29th or made public their fiscal year 2026 lapsed appropriation contingency plan version 2. And this is what was going to happen if there was no deal, right? At this point for the shutdown plan. As you're obviously aware, there was no deal. We do have to go through shutdown. And this plan is interesting, but it is very short. Okay. Now, one difference from prior shutdowns we've had before is that this plan says initially normal IRS operations will continue. So this week there was no change, right? We hit October 1st and nothing really changed at the IRS level. Nothing significant. There were some things, the TIGTA website went down, a few things like that were related, and it'll probably be down until they get funding back again. But otherwise it's there. But from the IRS standpoint, the issue is they have multi-year funding that was provided by the Inflation Reduction Act. That multi-year funding was available all the way through September 30 of 2031 when it was appropriated. Because those funds don't depend on the annual process, the IRS can access those funds to keep operating during a shutdown. Now, it's going to be an interesting decision as to how far they want to go into that or can go into that and continue operating. But for right now, we're operating because they designated their entire workforce of 74,299 employees, which is down about 20,000 from where they were to start the year, as exempt under Category A1 under these plans the agencies have to have. And these are activities funded by sources other than annual appropriations. So essentially, they can keep working, which is somewhat good news for things like the OB3 guidance and getting the final returns filed for last year, right? So currently, IRS functions and departments are fully operational. That includes appeals, chief counsels, criminal investigations, examination collections divisions for large business industry and small business self-employed, taxpayer service on the phones, and the taxpayer advocacy service. Now, for us and our clients, it means that returns are going to be processed, refunds will be issued, phone lines will be answered. Well, yeah, assuming you can get through. That we're not going to make that better, you understand. We're just going to have it there. Audits, collections, and appeals are going to proceed as scheduled. So if you have an appeals hearing scheduled for basically for Tuesday on the 7th of October, it's going ahead. We'll do that. And most importantly, deadlines remain in effect and enforcement did not pause during this period, at least for the first 5 days, because that's the hitch on this. That plan only explicitly covers the first 5 business days of a shutdown. The agencies have these initial plans, but after 5 days in, everything gets reevaluated. And the IRS may change what continues to operate as normal and what doesn't after the 5 days. One big question is, while the IRA funding is available through 2031, we don't know. When they published this, it's a very bare bones plan, and it certainly didn't provide information about how much funding remains. We know it's been reduced multiple times. How much that funding remains from a supplemental appropriation, and how long can it last, or how long will they continue to draw on it? We don't know. We just know first 5 days they're going this route. If a shutdown is prolonged, let's say if the funds are exhausted or otherwise the service feels it's not prudent to access them any longer, then obviously the IRS plan would need to be modified, and we need to keep an eye out for that this week. But for now, at least for the first 5 days, as we've noticed so far, the IRS is effectively insulated from the immediate effects. Eventually, they wouldn't be. Now, as a practical matter, I suspect, certainly for things like the OB3 guidance and other issues, what may matter more here is, my understanding, is going to be more if people get paid and a little bit less about who stays on as essential. We'll just have to kind of keep that going. In one sense, it's kind of interesting political issues going on, and obviously all of this has very little to do with the IRS itself. The battle's not over that right now. but it's going to be impacted. So keep your eyes on this because, yes, if certain things do get shut down, the service decides to, expand the reach, or decides that they really shouldn't be spending this much in the funds, or frankly, the funds run out, then things may be impacted. Next up, we do have some OB3 guidance. Speaking of OB3 guidance, we actually have some that came out this week. IRS Notice 2025-50, that came out on September 30th, right? Bottom line. Now, this was guidance on rural qualified opportunity zones, right? So the notice provides this guidance on qualified opportunity zones, QOZs, remember, that were amended by the One Big Beautiful Bill Act. And the key area was in rural qualified opportunity zones. Remember, it provides enhancements and enhanced benefits for rural opportunity zones under what we'll kind of say is our second version of the opportunity zone rules. So two key changes is there's a modified, more lenient substantial improvement test for property located in certain rural qualified opportunity zones. That'll be considered substantially improved with spending less funds on the improvement. And there was a modified statutory definition of rural areas under Section 1400Z-2, which was complicated by the fact that the Census Bureau, Commerce Department Census Bureau, changed their terms, but the law is still using the old terms. So yeah, they had to deal with that. I think the Agriculture Department had to as well a while back. So the IRS kind of followed their lead. So this notice is going to clarify these provisions as they would apply. The new 50% substantial improvement test. Under the Tax Cuts and Jobs Act, property could be substantially improved if additions to basis during any 30-month period exceeded 100% of the adjusted basis at the beginning of the period. So it didn't have to be brand new things being put in, right? It just had to be substantially improved real property. And previously, though, that meant that you had to put into the property, basically 100% of the adjusted basis at the beginning of the period of the property. So you acquired the property, you had 30 months to essentially spend at least as much in improving the property as your adjusted basis was after you had acquired the property. So that's where the 100% test comes. Now, under OB3, the One Big Beautiful Bill Act, tangible property located in a qualified opportunity zone consists entirely of a rural area. The OB3 reduced the substantial improvement threshold down to 50%. So let's say that the unadjusted base or the adjusted basis of the property was $500,000. Under the TCJA test, I would have had to put $500,000 of improvements in. And that would have been a substantial improvement. Under OB3, as long as it's a qualified rural opportunity zone, right? So it's a rural area, entirely rural area. That means I just need to put in $250,000 of improvements would do it. Now, this 50% test took effect for any substantial improvement termination made on or after July 1st, 2025, the date that the OB3 was enacted. We also have a definition of a rural area. Notice 2025-50 provides that a rural area under the statute is any area other than a city or town with a population greater than 50,000 and any urbanized area contiguous and adjacent to such a city or town. Now, what made the interpretation more interesting was in the post-2020 census, they eliminated the distinction between urban clusters and urbanized areas was done by the Census Bureau. They now just use the term urban areas to cover both. So, that was supposed to be an urbanized area, but we don't really have that separated from urban clusters. So following the approach the Department of Agriculture used with the same problem in the statute that used the same term, the IRS will interpret the statutory term urbanized area to mean the 2020 census term urban area. So based on this methodology and the 2020 census data, the Treasury IRS has determined that 3,309 of the 2018 qualified opportunity zones qualify as being comprised entirely of a rural area. And that complete list is found in the appendix to this notice. So if it's important to you, go grab the appendix. More changes in guidance. This is interim change in the corporate AMT. We've discovered some issues like this before, but these are notices 2025-46 and 2025-49. They were both issued on September 30th of 2025. Okay. Now, the Treasury and IRS has issued two notices that provide interim guidance on the corporate alternative minimum tax. Now, as you should be aware, most of our clients, if you're in a small practice, you're in a local practice, probably if you're not in a national practice, or working for a very large corporation, you're not facing the corporate AMT because it would apply only to C Corps, and there is a rather high revenue side to getting into it. But if you do, it is important to know that these changes taken place. This guidance responds to critical comments that were made on the 2024 proposed regulations and is intended to reduce compliance burdens and provide clarity. Now, unlike the regs we talked about earlier, these regs were not essentially quickly finalized before the end of the prior administration. So now we're just kind of backing off those. They were proposed, but not finalized. So they're going to modify and issue new proposed regulations that are expected to incorporate this guidance, and taxpayers may rely on the guidance in these notices immediately. Now, the corporate alternative minimum tax is a 15% minimum tax on adjusted financial statement income, AFSI, of corporations with average annual adjusted financial statement income of over $1 billion. Again, not something your average local firm is going to have. Not many C Corps, not many C Corps, B, not many of them have over $1 billion of financial statement income that you're going to be dealing with. But if you do, this is important. So 2025-46. Okay, corporate transactions and consolidated group, right? So 2025-46 was issued. A domestic corporate transactions, it largely replaces the proposed covered non-recognition transaction framework with rules that follow the regular tax treatment or subchapter C, but they use the corporate AMT inputs, so like corporate AMT basis, that sort of thing. This was meant to avoid what they call the cliff effect, where a minimal amount of boot could trigger full inclusion of the item of the income. There also are financially troubled company rules. They simplified and refined rules for cancellation of indebtedness income to more closely monitor the tax provisions under Section 108 and Section 1017, including excluding COD income if you qualify to exclude under 108, and reduce CAMT attributes under the rules similar to Section 1017 for reducing attributes in the case where you have cancellation of debt under Section 108. Now, tax consolidated groups, it replaces the simplified proposed framework. Termination of consolidated groups AFSI will now be governed by the existing consolidated return regulations under Regulation Section 1.1502, with substitutions like AFSI for taxable income and CAMT basis for adjusted basis, where the rules use those other terms from the regular tax return. Finally, acquired basically FS financial statements NOLs. The burdensome separate tracking requirement for financial statement NOLs acquired in a successor transaction has been eliminated under this guidance in the notice. In Notice 2025-49, we have reliance rules and specific adjustment citations, right? Under the proposed regs, if you wanted to rely on the proposed regs, you had to rely on everything. So here's some changes made. First, no section of the proposed regs will be applicable before a corresponding final reg is issued. And a taxpayer can now rely on any individual section of proposed regs without having to adopt all the others. They can rely on interim guidance in the notices as well without being required to follow any sections of the proposed regs. So it's not like you have to go all under the new system if you want to rely on any of it. And it provides two new elective options to disregard unrealized gains and losses from fair value accounting in your AFSI if the item is not marked to market for regular tax, which eliminates certain issues that would arise and distortions that are going to arise from that kind of background. Now, the key adjustment citations, again from Notice 2025-49, There's for regulated operations, those covered by ASC 980. Go to FASB reference today. It allows regulated utilities to deduct certain capitalized repair costs in the year incurred for AFSI purposes. We also have the tonnage tax regime, which goes to subchapter R of the Internal Revenue Code. It adjusts AFSI to align with regular tax treatment or subchapter R to avoid undermining the regime's policy goals. So if you're into that, there's something. It also has a pre-2020 embedded depreciation rule. It allows a portion of regular tax NOL deduction to reduce AFSI to account for depreciation that was embedded in pre-2020 net operating losses. There are special rules for goodwill amortization. For eligible goodwill acquired before the CAMT's enactment, it allows an AFSI reduction for the 197 amortization deduction to reduce the number of book tax differences. So you're going to allow that kind of, as essence, those sorts of issues. So basically, the ones you already had and were amortizing at 197 will still be under 197, not using FASB's method of looking for whether or not it's been damaged. That's the best way to say it. And finally, for accounting principle changes, there's a simplified option to calculate AFSI adjustments from changes to retained earnings without carving out the pre-2020 portion. Again, if you're involved in corporate AMT, just realize we have some significant guidance, and you want to go follow and take a look at these two notices. Next up, Notice 2025-53 on September 30. Did you notice they were pushing a lot out? Just before shutdown day. I thought that was kind of interesting. Apparently, they may not have been totally sure what the whole game was going to be. They got 5 days, but they were rushing. So this is another September 30. That's why we have so many things up this week. So the IRS has issued new relief under IRC Section 7508A, which is a section of the code that allows postponements of certain due dates for certain items in various situations, one of which is, taxpayers impacted by terroristic actions. Under 7508A, the Treasury Secretary can postpone deadlines for up to 1 year for those affected by a terroristic or military action as defined in Section 692C2. Now, the affected taxpayers will apply to individuals and businesses in the State of Israel, the West Bank and Gaza, as well as relief workers, those whose records or preparers are in the area, and any others directly impacted by what's been going on. Taxpayers outside the cover area may need to call the IRS Disaster Hotline, get that name right, at 866-562-5227 to request relief under this bill. Right? It does that under this provision. Now, what this does, it postpones the due date for taxpayer and government actions now for another year to September 30th, 2026. Right? It had originally been doing it through September 30th, 2025. Now, this relief applies to any acts originally due between September 30th, 25 and September of 3026. That includes filing most tax returns, paying taxes, making retirement plan contributions, filing tax court petitions, and if you need the full list, you go to Revenue Procedure 2018-58. Something we got used to looking at basically during the COVID era, right? Because again, because 7508A is also involved in that extension. So you get back to that RevProc. Now, it does interact with prior relief, so it extends relief previously granted by Notice 2023-71, which was to October 7th of 24, and Notice 2024-72, which pushed it forward to September 30, 25. That means eligible taxpayers now have a cumulative extension until September 30, 2026 for any acts required by the three notices. So, somebody could be extending these out for something that was required to be done, after the effective date of Notice 2023-71, which was in October of 23, all the way through now to the end of 26, or to September 30th, 26. And we'll just have to see if they extend again next year. See how the situation is going. More reg changes. This is final regs on interest capitalizations for improvements. Yes, they were closing out a lot of projects here. It is the fiscal year end too, so that's also part of the reason for the closeouts. But there was a lot came down this week. These are final regulations to streamline Section 263 Cap AF. Right? The citation is Treasury Decision 10034. These were published in the Federal Register on October 2nd of 2025. Now, these are final regulations to simplify the interest capitalization rules under 263 Cap AF for improvements to designated property. These are essentially the avoided interest rules that require you to capitalize certain interests when you're essentially self-constructing certain property or constructing certain property, right? So there are three principal changes made to these rules. Now, these rules are effective to taxable years beginning after October 2nd, 2025, and a change to conform with these rules is going to be a change of method of accounting, going to require a Form 3115 to be filed. So keep that in mind if you're impacted by these. Okay. Now, the key changes in Treasury Decision 10034 is the elimination of the associated property rule, which is probably the biggest change. The regulations remove the rule from Section 1.263 Cap A-11E that required taxpayers to include the basis of existing associated property in the accumulated production expenditures of an improvement. Now, APEs will generally only include the direct cost of the improvement itself. That's important because in the avoided interest rule, the avoided interest rules, I should say, those higher costs will attract more of the interest expended by the company in general. The idea here was that, to the extent that you didn't go get financing, you don't finance this, but you have other interest out there, you could have paid off that interest and rather finance this. They're saying so that's backdoor financing this improvement. So because of that, we're going to capitalize. Weird set of rules, but having less costs in there is helpful in terms of not having to capitalize as much. They also, in revising definition of what's an improvement, they sought to make it consistent with the tangible property improvement rules in Regulation 1.263A-3, little a-3. Those are the rules back in 2014, it's been that long, that were adopted that, changed our repair and capitalization regs for tangible personal property. This is now changed definition at 1.263 Cap A-8 D3 to basically align it with the framework for tangible personal property improvements in those 2014 regs. So it provides a greater consistency and incorporates all the safe harbors and elections found in the capitalization regs. And also have a bit of clarification of mid-production purchases. The rule and regulation 1.263 Cap A-11F is clarified that it applies when a taxpayer purchases a unit of property for further production before, which is the key clarification, it's placed in service. Next up, we have the 8th Circuit Court of Appeals reverse the tax court in the 3M case. So there's no 482 allocation of block foreign income. That citation is from 3M Company and subsidiaries versus Commissioner, Court of Appeals for the 8th Circuit. This was case number 23-3772, and the opinion was issued on October 1st of this, 25, this year. So this is a reversal of the tax court, right? The 8th Circuit reversed the tax court, holding the IRS cannot use Section 42, which allows them to reallocate income among related entities, to allocate royalty income to a U.S. parent that its foreign subsidiary is legally prohibited from paying under the foreign law. Now, the facts of this case was the Brazilian subsidiary paid to 3M the maximum royalty allowed under Brazilian law. Now, the IRS and 3M agreed that that amount was less than what a true arm's length amount would have been. But Brazilian law prohibited 3M from being paid more than that amount, from taking it out of the country. So what the IRS said, well, that was an additional $23.7 million. Would have been an arm's length amount. Even though Brazilian law said that 3M could not take it out. They said, we don't care, we're computing the income, that essentially you need to pay tax on, and we're saying that there should be another $23.7 million of royalty income. So what happened here was, in this case, the court reaffirmed the appeals court and overturned the tax court the dominion and control standards from Commissioner versus First Security Bank of Utah, which held that for income to be allocated 42, the taxpayer must have complete power over it and could have received it. Now, the tax court's decision was issued prior to Loper-Bright coming down. Okay. So, Loper-Bright is where we get into this. This was one of the first circuit court decisions that applied the holding in Loper-Bright, which instructed the courts to abandon deference and adopt the best reading of the statute without regard to the agency's interpretation. Well, you can, it's weirdly phrased. You can use, you can kind of pay attention, but not totally. It's just going to be an influence. So you're looking for the best reading. To the extent it is a legal issue, then the courts are going to be presumed essentially to have the better expertise than the agency in that area because the courts are charged with interpreting the law. That's the basics of Loper-Bright. Now, the IRS argued the second sentence of Section 482, the commensurate with income standard for intangibles, superseded First Security Bank. The court rejected it because it held that second sentence, and you read the opinion, you'll find out about this bit, but it's merely a measurement method. How much, not an expansion of the type of income that's subject to allocation. So they're saying the amount subject is separately determined. The court found a distinction between a foreign law prohibition in 3M and a domestic one in First Security Bank did not matter. Either one could deprive a taxpayer of control. And obviously, they said they couldn't take it. They also flatly rejected the IRS argument that 3M had control because subsidiary could have paid dividends. And noted, well, there's fundamental legal and economic differences between a dividend and a royalty payment. And because of that, and also said, we don't think it's really the regulations say that they need to violate, in essence, well, because he could get it by violating Brazilian law, well, that's fine, it counts. I said, no, that doesn't work. Now, this is interesting because, as I said, this is one of the first cases that's taken a look at Loper-Bright, and it suggests that had this appeal come to them before the Supreme Court had ruled in Loper-Bright, they may have very well sustained the tax court. And of course, also raised the question that the tax court decided after Loper-Bright, they might have decided differently. But this is one. Now, again, like all things of this sort, we do not expect the IRS to abandon this position based solely on one Court of Appeals case. In the Eighth Circuit right now, under the Golson standard, yes, the tax court is going to follow this ruling in the Eighth Circuit. And because of that, the IRS would need to follow it, because the taxpayer would go there and, in a district court there. Remember, the IRS doesn't really have the choice of, a venue. They can't force this to the Court of Claims, which is the one place that somebody, let's say a company based in the Eighth Circuit, that's the one place you could try the case that wouldn't necessarily have to care about the Eighth Circuit precedent. But again, you wouldn't take one of these outside of there generally, unless it was some other issue here that wasn't going to go well in the Eighth Circuit. Why risk the Court of Claims? Or why risk the Federal Circuit? So that's it. But if you're not in the Eighth Circuit, realize that, keep an eye on the IRS. They could acquiesce in this decision, in which case then they'll follow it. They could decide to try to fight it in another circuit, get a circuit split, and then try to get that resolved. So we'll have to see what the IRS does. And talking about problematic regulations and standards, we have the basically Freedom Path Inc. versus Internal Revenue Service case. This is the United States District Court of District of Columbia, case number 20 CV 1349. The decision was issued on October 2nd. And this is where the district court found the standards under Section 501c4 for political activities of a C4 organization are unconstitutionally vague and therefore can't be used. So essentially, as I said, they held those standards to determine eligibility for 501c4 social welfare status are unconstitutionally vague under the First Amendment's Due Process Clause. Now, the background of this goes back a lot of years, but Freedom Path Inc. was denied a 501c4 tax-exempt status after the IRS determined using a multi-factor facts and circumstances test, over 50% of the activities that they were engaged in constituted political campaign intervention, which is not, which again, CIF organizations do face limits on, political activities. Now, one problem we have is it's a little vague about what it was. Congress was intentionally vague, which is, it's a crazy law, but it's the law we got. Okay. Now, following the D.C. Circuit Court precedent in the Big Mama Rag case, how's that for a name of a case? The court applied a more stringent vagueness test because regulations affect First Amendment free speech rights, even though they are technically about denial of a tax subsidy. They're saying because that's denial of a subsidy indirectly has an effect on, basically it's based on a speech criteria. They have to be, a bit tighter on these regs. Now, the court found that the framework was unconstitutional due to a compounding uncertainty of two vague standards. First, the IRS lacks a clear definition of what's a primary activity, what's primarily engaged in social welfare. The opinion notes that the term has been inconsistently defined as meaning anything from over 50% to merely more than insubstantial, which could be a relatively small amount, well less than 50%. They're saying, well, that's vague because you're supposed to be the primary activity. Are you primarily engaged in social welfare, or are you primarily engaged in political activities? And so they're saying, well, obviously that's, a vague test here. Do we need to have more than 50% in social? What is it? Or does it mean if you had 80% in non-political activities, you could still be denied? Not clear, and it's been used different ways, and the reg doesn't really tell us how to test it. And finally, what is a political campaign activity has an 11-factor test from Revenue Ruling 2004-06 that was used to define political activity is open-ended, rough-and-tumble factors with no guidance on how to weigh them, which gives IRS agents wide discretion in deciding things and potentially, therefore, allowing them to let their own beliefs influence whether or not something represents political activity. And as you're probably aware, people are naturally be more likely to object to something and claim it's political activity if it happens to be a position they don't agree with. Amazing how that happens. You can go to social media, you'll see that in no time flat. So yes, we're going to see that's there. Now, Freedom Path said, well, because these are unconstitutionally vague, we just win. And court said no. They've not yet granted Freedom Path exempt status. They said, fine, the regs and the rules are vague. But merely saying the regs and the rules are vague doesn't mean you get exempt status. You still got to meet the statutory definition. And the court said because congressional rider has for many years prevented the IRS from issuing any new guidance in this area, the IRS is barred from issuing new guidance. So because of that, the court says, well, Congress has essentially, if this guidance is invalid, Congress is saying we need to hear from both parties, the IRS and the entity, regarding new constitutionally sound standards grounded in existing law. What is the test? How do we determine if they are? And that's something which I do point out to people when we talk about things like Loper-Bright challenges. The mere fact that the reg is invalid, great, but we still then got to go back and figure out what does law say, because that's what Loper-Bright says governs. And, it doesn't matter. If the reg isn't a proper interpretation, we still got to find one. And that's the issue in this case, going back for additional trial. Okay, what is the proper test? So the only thing we really take from this, and this is in a DC district court, so, keep that in mind, is probably not going to be applicable, widely applicable yet. We'll see if others follow the standard, is just that, okay, these rules are too vague, but, what are the rules? We don't know. So, yeah, it's kind of in a no man's land there. Next up, the Green family and Hobby Lobby Another case involving a charitable contribution, right? And we got two different opinions. And case citation, Green 1993 Dynasty Trust plus a number of others versus Commissioner. One of these cases is a public tax court decision, 165 TC number 7, and the other is a memorandum decision, TC 2025-100. Both were issued on October the 2nd of 2025. So the tax court issued two opinions on the same day on consolidated cases involving the shareholders of Hobby Lobby and a large non-cash charitable contribution of biblical artifacts. The facts of this situation: Hobby Lobby, an S corporation, donated over 1,200 artifacts in 2011 to 2012, claiming deductions of over $84 million for those donations. The IRS denied the deductions for failures to meet the 170 substantiation requirements and asserted gross valuation misstatement penalties. Now, we have two opinions covering two different areas. First, we have the reviewed opinion. This is one in which the entire tax court, acting as a whole, all the judges basically chimed in on this and decided, and basically joined decisions, either the majority opinion or one of the two dissents, that address substantiations of the deduction issues. And Tax Court Memorandum Decision 2025-100 addresses the procedural validity of the penalties under 6062 that the IRS is asserting. So weird, but we have two different opinions to work with here on two different parts of essentially the same transactions. Now, the IRS argued that the Forms 8283 for non-cash contributions were defective because they failed to itemize basis acquisition dates for each item. Rather, they just kind of had groups of artifacts that they put in. And they were missing signatures from two of the individuals who essentially were part of the appraisals. Now, these people signed on the report, but they didn't sign on the 8283. Only one appraiser signed the 8283. Now, Hobby Lobby's claim was, they claim, well, either strictly or substantially complied with the substantiation rules, right? Even if they didn't, the failure would be excluded under the reasonable cause defense that was found in section 170F11A double I and then double big I, based on their reliance on Grant Thornton that had reviewed the return prior to being filing and reviewed the documentation that was there, basically the appraisal, the 8283, etc., for correctness. They said we should be able to, get out under that. So it wouldn't matter if the report was defective. If it didn't strictly comply, we would argue it substantially complied. And if it didn't substantially comply either, then we're going to argue, reasonable cause. And we've talked about that before, that reasonable cause is something that's available if you have an imperfect, basically report, an appraisal report that's imperfect. You can still get in here. Unlike, let's say, gross valuation questions, where you can't use reasonable cause, you can for whether the report was there. And you can't really use reasonable cause for a lot of flaws in charitable contributions, but this is one you can. Now, the majority of the tax court denied all motions for summary judgment because both the IRS and the taxpayer had moved for summary judgment on this issue. Were they properly supported or were they not? In essence, did they qualify as complying with these rules or did they not? And if they didn't, then, would reasonable cause. So the IRS moved to say, nope, they're totally wrong. So the entire deduction is going to be dead anyway. And the taxpayers said, no. We either substantially complied or we have the reasonable cause option. So the majority said it denied them all. It found the reasonable cause defense is inherently fact-intensive inquiry that must be decided at trial. Now, why there are dissents on that part, fine. But Judge Jenkins, which in one of the dissents, argued the majority case put the cart before the horse. It didn't first decide the purely legal question of whether the taxpayers complied. Because if the taxpayers complied, strictly or substantially complied, then it's irrelevant if they had reasonable cause, right? We're done. the court hasn't decided that question yet. And Judge Jenkins said that question, he believed, could be decided solely from the legal question before the court. Get rid of that. Figure out, do we have an issue here? Because the parties had conceded the facts of what happened. So strict or substantial compliance. You should have been able to say, hey, if they fail to substantially comply or strictly comply, then and only then does reasonable cause matter. So why didn't you deal with that first? And if they did substantially comply, then reasonable cause doesn't matter. So, the opinion shouldn't have been done that way. It should have been first looking at, why we needed to go to trial on the question of strictly or substantial compliance before we worried about whether, we needed to decide reasonable cause. Now, the second opinion, right, the memorandum opinion decided by only the original judge assigned to the case, the taxpayer was arguing the penalties that were being assigned were invalid due to a lack of supervisory approval under 6751B, something we hear a lot. Now, the court held that 6751B approval was proper. The initial termination of penalty occurred with the Form 4605A, not the earlier, notice of proposed adjustment. The supervisor written approval, predated the 4605A, making it timely. And for a pass-through entity, supervisory approval that names the entity Hobby Lobby is sufficient. That was one of their claims. You needed to name each shareholder, right, and have supervisor approval. As evaluation misstatement is determined at the entity level, so we don't have to list every single shareholder, and have that approval for that purpose. The court also denied summary judgment on application of penalties, finding taxpayer reasonable cause defense under 6664C remains disputed to issue a material fact for trial in areas where it could apply. So we need to go to trial on that issue. So essentially, Hobby Lobby, two issues. Again, they've gone to court numerous times, and this is just one more, and almost always has been on charitable contributions. So they're back there with the same issue. So again, this has been the Current Federal Tax Developments for October 6, 2025. Current Federal Tax Developments, as always, is brought to you by your state society of CPAs. I am available if you wish. You have questions, and I have time to get there, which this time of year becomes tougher, but still. Ed Zoller's at currentfederaltaxdevelopments.com. You can do that. Also, I do look at the Connect sites for a number of state societies: Arizona, New Jersey, Idaho, Minnesota, Illinois, Washington. I look at those from time to time. And so if you have posted a question there, remember those societies, I may answer something there. Otherwise, we are coming up to time. I am really not sure if next week there's going to be time to actually put one of these together for the week of the 13th, in which case then it may be deferred. We'll do a super coverage then for the week of the 20th. But otherwise, hopefully have a good week. Get your final returns out, right? The final calendar year returns, except for not-for-profits, are due this, coming up on the 15th. So take care of that as that time approaches, which when this the official date of October 6th for this week's one will give you 9 days to work for that, right? We'll be nine days out. So take care of that, and we will see you in the future, maybe not on the 13th, but, at least sometime later this month for current federal tax developments.